Hey guys, Brian Horton here with BK Forex Academy. I have a question for you. Do you typically struggle when to enter and exit into your trades? Using a simple support and resistance strategy will help you to identify that and trade confidently. Using market structure, now we're thinking like the banks, finding your supply and demand areas in your chart so that you can confidently enter your trade, know when to get in, go your way, and exit. Now, is it 100%? No, because no strategy in trading is 100%. However, this will narrow your chance of price going against you and going for you right at this. All right, guys, so before we can even identify the support and resistance levels, we need to understand first what is support and resistance. So support and resistance are certain areas that has reacted in the past and can potentially react to it again in the future. So here are some things that you need to identify a support and resistance level. Number one, we should have multiple rejections in an area. I'm going to show you this after. Number two, swing highs or swing lows. So we're going to identify extreme swing highs and swing lows. Three, obvious levels that you can spot with your naked eye. Number four, significant move away. And I'll talk a little bit about that. And then number five, levels acted as both support and resistance. Now, you do not need to have all of these traits listed to qualify the level of support and resistance. And we'll go over that. But the more, the better. So let's go over some examples here. Now we have the Aussie New Zealand dollar 4-hour chart here. So we're going to show you first the multiple rejections. We're going to go through the step 1 through 5 here, the multiple rejections. So before I go ahead and show you, I want you to just look at this chart here and see if you can easily eye your support and resistance zones. There could be more than one. I'll point out 3. So just kind of look at it. And you should be able to look at it and identify it easily. If not, it's okay. It takes a lot of training to do that. Sometimes it comes natural. Sometimes it takes time. But either way, you should be able to easily identify it. So I'm going to draw a line here. So this is going to be my resistance area. So resistance is usually the top of a structure in which price bounces off multiple times. So you can see that price has bounced off multiple times. Here is a support level here where price has bounced multiple times as well, but from the bottom, from the top, bouncing off to the bottom. And then here is another support area as well. So we'll talk a little bit about this. Like I mentioned in step 5, you have levels both acting as resistance and support, but we'll go ahead and get back into that in a minute. So look at this arrow here. We have the candle bouncing off. We see the wicks going through it, and that's okay. But we see multiple bounces off the same area, each candle representing 4 hours in time, multiple bounces. And this is not by accident, right? This is by supply and demand. We see supply and demand in the market every single time. And so that way we can react in the future what it has done in the past. Multiple bounces off of this line. Now, the middle line here, we see multiple areas in which price has touched it and didn't go below it, right? So it touched it, didn't go below it. So it's bouncing like a ball from the ground to the ceiling. So this is your support line. So think about support, something holding something up. So when you're supporting something, you're holding something up. So that's like your floor level here. And now we have the bottom line in which this is act like a support as well. We have multiple candles bouncing off, respecting that area. Same on the right side, bouncing off of this area. So this is your support line. Now let's look at this from a logical perspective, right? I extended those lines here at the top, the first two. So let's do this. Let's imagine price going up from your support line, which is at the bottom, to your resistance line. So when price moves up, this means there are more buyers than sellers. And it can also mean that the institutions and hedge funds are trading with more money than sellers are, like in contracts. But usually once price hits a heavily resistance area like this, one or two things are happening. Buyers are either closing their positions, in other words, they're getting out of their trade, or there are simply more sellers entering the market, or it can be a combination of the two. And if it happens to push down fast, then that can mean buyers are exiting their positions because sellers are overpowering them, which results in them losing funds. So usually, let's say you're in a buy, but price is going down. Usually people would get out because it's going against them. They're losing money and they may even put themselves in a sell. So usually when a trend starts, that's when people start putting positions in and it starts to head in that direction. All right. So number two, we talked about swing highs and swing lows. We're talking about extreme swing highs and swing lows. So what is that? It's nothing more than when price goes up to the top, to the highest it's been, it caps off, comes down to a swing low, and then it does the same thing. So it's kind of your support and resistance area is going up, coming down, going back up, retesting that top, or at least that area. And remember, your supply and your support and your resistance zones are not specific price, it's an area. So your area can be 10, 20, 30, 40 pips wide. It doesn't matter. So I usually draw a line to show my support and resistance areas, just like this here, and that line could be as thick as you want depending on the time frame. So if I'm trading the daily, that means either entering a swing trade, maybe even a position trade, maybe intraday trade. So I'm looking at the daily chart. I'm not going to be in a trade for just 15 minutes. So my structure levels, my channel, my support and resistance zones should be pretty thick, so that if price continues to go against me a bit, it doesn't phase me. I don't mind losing a few pips if I know I'm getting in the best price, right? So this is your support area at the bottom. So remember, support is supporting you. It's like the floor level, and then your resistance is at the top. It can't break through that barrier. Now, eventually, price breaks through your support or breaks through your resistance area, and we'll talk about that in a bit. Let's look at a live example. Okay, so here we have the Aussie dollar again, the 4-hour chart, right? We are going to look at a live example of number three. So number three was the level should be obvious to the naked eye. Okay, so we're just going to pick a level here, and I'm going to extend this chart here. And to the naked eye, you should see the top of a price, in which this is like your swing high, your resistance area. And like I said, it shouldn't be a straight line. So let me delete this and explain what I mean here. So it shouldn't be a straight line. Now you can use a straight line maybe to easily identify the top, but if price happens to go above it, you're not getting out of the trade and discouragement, right? So I like to delete this here, and I like to use this rectangle here, and I would extend it here. I like to usually bring it down to the bottom of the candle, the lowest candle, and extend it up. And if I'm swing trading, my rectangle could be anywhere between 75 to 100 pips, and I can withstand that from my account. So you want to make sure you use proper risk management. So I usually get my measuring tool here, measure from the bottom to the top, and that's 24 pips. So if price happens to come against me, let's say price is here and it goes up and it comes here, I'm okay because it's within my rectangle and it's within my risk management within that 24 pip loss, right? If it extends here, then I'm okay. So I like to make this kind of a wide rectangle depending on my 2% risk management rule, or whatever risk management you're using. And that will be my resistance line, my resistance area. My support area would be the opposite, would be at the bottom. I should be able to easily identify my resistance area. You can see candles touching this area multiple times, right? It's gone through with the wick, and that's okay. But for the most part, we see multiple candles bouncing off of this area. That's nothing more than supply and demand, right? So we notice, as I mentioned before, that supply and demand, your support resistance isn't going to stand forever. It's going to break through. In this case, it broke through. And then once it breaks through, you want to know how long is it going to go through? Are you going to sell? Are you going to buy? So I like to look left for clues. So I'm going to look in the past to see when price has gone that far, and that may determine how far I'm going to get in the trade or when I'm going to get in the trade, right? So last time price was there was back here in February 2021. So I can extend my new support zone here. If it happens to go here, right? And then I can go for a buy because the past has told me so, and it marked my support line here. Okay, so I may not get in the sell once the price comes down here, but I may go in a buy when price comes down right there. All right, let's go ahead and show you another example, or an example of the move away I talked about. I know that sounds strange, but let's take a look. So remember step number 4 when I mentioned that move away area. And the move away area, what I mean is that you want to allow enough time and gap in between when it touches your support area to your resistance. And that time and gap is right here, you know? So we see this nice little gap here in between price hitting from your one zone to the next zone. Same here in this area, and then they all have something in common. It doesn't matter how much gap, you just want to see some gap as long as price touch one area and then also the other. This is your supply zone and your demand area. So your support and resistance. And it doesn't have to be back to back. So this candle doesn't have to touch this area back to back. We can actually go and look in the past, and we can also see that price has touched this area before. So it doesn't, this, let's say this wasn't here, it didn't quite reach this high, and it actually fell short to about this area. You can still see that this is still a major structure area, or this a major structure zone. Even here at the bottom, it doesn't have to go back to back, but you can look in the past and scroll and find out when price was here last. And you can see, if you see multiple candles or even wicks touching that area, like here, 1, 2, and 3. And then you can even see in the future. So we look in the past to predict the future, in short. So now let's go ahead and look at when I mentioned that your support and resistance line can act as both, and what I mean by that. So I have a line here drawing right where I've seen multiple points at, or multiple candles touching at an area. And then we start from the left. This is going to be our resistance. So remember, resistance is at the top. We see price respected this line here, also right here, and over here as well. And then eventually price broke through that resistance, gone up now from support and hit downward right there. So we can see price is now support, which is at the bottom, and it respects that area. So it's nothing but supply and demand, and traders understand that. So they know when price comes down to that area, next time it comes down, they may want to go up for a buy because it respects that area. Price touched this again, price went up, then it went back down, went up, went back down, went up, went back down. Multiple times it's gone up and went back down. And so that's why we can sometimes predict when price is going to go our way, because of these levels here are respected as supply and demand. So think of it like this. When you're purchasing something, let's say you own a business and you own a shoe business, your job is to make money. And you can't make money if you are buying shoes from a wholesaler or from someone who's making them and then selling them for the same price. You have to buy them for a smaller price. And you know that. When you buy them at a lower price, then you can sell them at a higher price, but you have to know what price your buyers are willing to pay. You don't want to mark them up too high because they're not going to buy it. You want to mark them just right for depending on the quality of the shoe, the name brand, and so on and so forth. The same here. We identify this resistance area and support line. That's like our supply line here. We get supplies and then we build a demand from the market. They get excited and they buy it at a higher price. That is pretty much it in a nutshell. All right, so going back to the Aussie New Zealand dollar, we see prices here. We marked our levels of support here, resistance here, and every time price has hit our support or our supply, we buy for cheap. Okay, price goes up and sellers will take on it. All right, and then when it gets too much, price goes back down because it needs to attract more buyers. Once it attract more buyers, people start to buy and they say, oh, you know what? I see this current resistance area here. And every time it hit this area, people sold. So I'm going to do the exact same thing, because if I stay in a buy, I may lose money when price comes down. So I might as well sell it. And that's all it is. They're identifying these levels in the market. You will buy here. Price goes up. When you see it starts to hit your resistance area, you know it's going to attract sellers because it is a good time to sell. If you hold on to your buy while it's going down, you're losing money. So you want to let go with the crowd and then start selling again. All right. And that's pretty much it. Identifying your supply and demand, your support resistance zones. Now, before you enter hitting your demand area, you don't want to enter in hopes that it goes up. You want to see a white candle in my case, or maybe green, depending on what color candles you are, a white candle giving you hope that price is going to go up, right? So in this example here, we see that it broke through. So what if you bought here? I'm waiting for a white candle, but I see this long red candle. So you don't want to enter and then you see a red candle when it's going against you, okay? I mark this as another support area. So I would have bought here, and although it dropped a bit, it's going to come back up, okay? Because this is a strong support area, a strong supply area. So that's how you can identify your entries in the market, okay? That works on every single time frame, whether it's 5 minutes or monthly. However, I always recommend starting from the daily, because then you can identify your trend. You want to identify your main trend, and this is what the banks and the institutions and the hedge funds trade. They trade from the higher time frames, like the weekly, the monthly, the daily, because they want to see the entire trend. They're making millions and millions of dollars. So they're not in scalping, getting 15 pips, 20 pips. They're putting in thousands and thousands of contracts, which is millions and millions of dollars, trying to get the lowest price all the way at the bottom, and then releasing it at the top and hitting their next zone here, right? And then it comes back down. Here's your next zone. It can either push here and go back up, or since I don't see a white candle or a green candle, depending on whatever's your buy, I'm going to wait to see if it's going to push down and respect this area here again. Okay, so it's nothing more than supply and demand, support, resistance. I hope that this video helped you out. If it did, go ahead and hit the like button and subscribe. Hit the notification bell, because it'll send videos just like this and related videos to you, notifying you that we have a new release. We thank you so much for watching. Don't forget to click the description to find out more about our academy. You have a good day.